This is so I don't fall asleep while I'm doing this. Some jet lag here. This is a talk about prediction in the markets, which is something we're not supposed to be able to do. So let's see if, just talk about it. And Bob did warm up a bit with some very nice examples, and I'll refer back to some of his examples of that. So as with everything, there's theory and practice. So let's start with theories. So if you're going to do some prediction in the market, it usually requires some assumptions. And the assumptions are almost always assumptions about what the probability distribution of returns are going to be for the assets you're looking at. And somehow or other we form some assumption or some estimate of what that distribution will be. Of course, in large part, thanks to some of the people in this audience, notably Gene and Dick, we have a theory that says you can't do this. Efficient markets suggest to us that predicting future outcomes is very difficult, if not impossible. It doesn't say that you can't form a probability distribution of returns, but you really can't say very much about what will actually occur. And this is a theory that I ascribe to both because I'm a theorist, I guess, and so that's what we do, we believe theories, but also because I've had some practical experience, and if it's possible to predict what the market's going to do, I can't do it. There are anomalies, and these seem to be a constant source of intrigue to people. So we have all these little examples of things where you can predict. And so I remember some stuff where if you take long-run returns, like 5-year returns, you can predict the next 5 years. Or if you do, complicated models, statistical models, you can use those to predict and things. And people in behavioral finance, which is a branch of finance that we won't talk about, this is an important perspective for them. Now, this is theory, and then there's practice. And practice is really simple. There's a lot of demand for predicting what the market will do, and as you'd expect, when there's a lot of demand, there's a lot of supply of people predicting what the market will do. And so you have demand and supply, and you can't really open up a financial newspaper anywhere in the world at any day without reading somebody's prediction of what's going to happen. And then there's almost always a track record. They say, well, so-and-so predicts that the market will do this, and so-and-so, by the way, got this right 4 years ago, or predicted the crisis in 2008, So they have limited track records, but they focus in on the exact ones. And there was this wonderful line, I remember, by Paul Samuelson once, many years ago. He was confronted with someone who people said, this person is very good. They predicted the last bubble in the market or the last crash. And he said, yes. He said, they have an enviable record. They predicted 7 of the last 3 crashes. And then they do this in different markets. We have 2 other markets. So we're going to talk about fixed income and equity. And I must say, this is a constant fascinating topic for me. I would like to be able to predict more than I can, and I actually don't know the limits of how much it is possible to predict. So let's look at forecasting in the bond market. So we all know how this goes, and Bob talked a little bit about this. So we derive the yield curve from bond prices, and if you look at the difference between a 5-year bond and a 4-year bond, or anything like that, you get a forward rate, and that difference is somehow or other related to the market's prediction of what the 1-year rate is going to be in 4 years. I'm very fond of this as a way of predicting things, because the very first thing I ever did in the world of business was I had a contract with an American bank to predict what interest rates were going to be in 6 months. And so this was a local bank in Philadelphia. I was teaching at the Wharton School, and they paid me monthly to predict the interest rate 6 months from then. And then I went on sabbatical, and I got a grant, and so I had this money coming from them once a month. I didn't know about discounting, so I thought it was good to space it out over every month. And the mistake wasn't discounting. What happened was that 6 months later, when they hadn't even seen if my first prediction was okay, they fired me. So I never found out. But what did I do? I just looked at forward rates, and I said, that's as good a prediction as you could get. And they paid me to do this. At the time, they didn't have banks that could do that. I didn't understand that. But we know forward rates aren't unbiased predictors of the future. Forward rates are biased. And they're biased because they embed a risk premium. So in these bond markets, you have people undertaking long-term contracts, and so they're taking a risk for undertaking the long-term contract. And sometimes the risk is subtle. It's not just the risk that the contract won't pay off. If it's a treasury bill, a treasury contract, it's going to pay off. The risk is really that your circumstances will change. And so there are risks associated with these things. And those risks are embedded in the pricing of bonds, and so they embed a risk premium. And so whatever you see as a forward rate, if the forward rate 4 years from now is 3%, that's not an unbiased predictor that spot rates will be 3% in 4 years. It's 3% plus or minus the risk premium. Furthermore, this is just a prediction, one prediction. So if from a distributional perspective, at best it's a prediction of the mean of the distribution, of the central tendency of the distribution. This is bond markets. What do we do in equity markets? So we need to know the expected return. As Geert talked about, we're quite interested in what the expected return is. So as Geert described, we often use historical time series. So we'll look and say, since 1926, the risk premium has been 6%, and we ignore what Gene says, that there's an error to that prediction, and we just say it's 6%. Or we go even further back. I always like these studies that go back to England. I once had an argument with someone about this. They go back to England, and they say, well, we only have 60 or 70 years of US data, or 100 years. But England, we have 400 years of interest rate data, or 400 years of equity returns. So we go all the way back, 400 years of equity returns. Well, that's true, but 400 years ago, most of England was covered with forests and had people in loincloths running around, And 400 years ago, it was a tiny little island off the coast of some big countries. Who thought that it would survive for 400 years? But conditional on surviving for 400 years, it probably had a pretty good equity return. But you didn't know that 400 years ago. So we use historical returns and the historical premium. We use statistical models. This is prevalent nowadays. So we use econometric models. As you all know, distributed lag models, a whole host of things like that. A dividend yield model to predict. We say, well, this is the rate of return you should get, so the market will go higher, down. Price earnings models have become very popular. So if you have a historical average price earnings ratio, or if you're technical on earnings price ratio, if you have a historical average of this, then if prices are high and the price earnings ratio is high relative to that average, you project that it'll fall. And we all do this. I mean, when asked the questions, we all say this. Or if the prices are low, so price earnings ratio is very low, so you're getting a high yield on equities, we predict that it won't persist and it'll rise later. So that's common. How do we predict? Now, we can do one other thing in these markets. We predict volatility. So not only do we predict what the price change will be, we also predict the spread of the distribution. And we do that by looking at historical volatilities, or now, if we're particularly modern, we look at the VIX. So we look at the volatility thing. My favorite one that we use is we do surveys. So we do sample surveys of market participants and institutional peers, and this is, the theory underlying this is the wisdom of crowds. It has to be that theory, because not a month goes by when I don't get a call from someone that says, what do you think the market will do? And if someone's asking me, they really don't know what they're doing. And if I knew, why would I tell them anyway? So it's just, so this is the status. This is where we are today, which is really kind of sad. So what this talk is about is something I've been working on for about 4 years. which I kind of stumbled upon by accident, which is often the best way to, certainly the best way to stumble upon things, but it's a good way to come up with stuff. So my hope has always been, going back to the days of using forward rates, my hope has always been that you could have another way of doing this, that in the rich markets that we live in, you could look at these prices that you see for all these assets. So what are these prices? We have an amazing variety of things in these markets, a huge number of securities. And these are securities which have prices that you see today, and they promise you payoffs in the distant future. So those prices should be informative about what the market thinks the distribution of those future returns is going to be. And it's like a code. It's like cracking a code. We should find a way to use the prices that we see today to untangle from it the market's prediction of what's going to happen in the future. And that's the hope of this subject. So that's what I've been trying to do. Because surely there's information in those prices, and we're not really making much use of it. Now, the market I'm going to look at that we make no use of really, although Bob talked briefly about some new work, which I think is quite interesting by who is it? Oh, I have a mental block. Breeden and Litzenberger. Some very good work that they've done from on this. And there's some research departments of the Fed that's doing this as well. So I'm going to look at derivatives and options, because that's one of my favorite things. Options are just special case of derivatives. And I'm going to say, here are the prices of things that actually are pulling out parts of the distribution. So if I look at a 6-month call option, so this is an audience that better know what puts and calls are, but in case you don't, you can quickly refer to this. So these are puts and calls, and more important than the options we always teach, which is on individual stocks, there's a huge market on options on the index, and I'll focus in on the S&P. So the S&P 500 has an enormous market. It is enormous, but it's not, just to put this in perspective. The notional outstanding in that market on a given day is about $20 trillion. So there's $20 trillion of, which I guess until recently was the size of the US debt or something. $20 trillion is traded on a day, but if you know about the options market, there's two dimensions here. It's not like the fixed income market. So on the fixed income government market, to give you a sense of the relative magnitudes, there is now $2 quadrillion of outstanding, which I believe is 1,000 trillion. So there's $2 quadrillion of outstanding, and yet the equity is 20 trillion. So it's a lot smaller. And in the government market, it's really distributed across one dimension, the maturity of the bond. But in the equity market, that 20 trillion has to be spread out across the strikes of all the options and the maturity. So it's $20 trillion, and each little piece of this could be pretty small. So it's not quite as big, but it's a big enough market, so it's liquid, and we can certainly figure out what's going on with it. Now, in that $20 trillion of options with strikes that range across the board and maturities that go out about 8 years or 9 years. If you go over the counter, they go pretty far. Isn't there information there we can use? That's what this is about. Let's see if that, and to use that information, we're going to have to use option pricing theory. So I'm going to talk about option pricing theory, and I'll have some equations too, but it'll be, I have some scary equations actually, some really scary ones. But so that's the volatility surface I talked about. That's just a way of representing prices. They use what I'll call the BMS model, the Black-Merton-Scholes model. And so I think Bob's name belongs in that model, so I like to call it the BMS model. And you use that model to nicely get rid of some effects of time and strike and quote option prices. So this is just a picture of the quoting of option prices across all the strikes and all the maturities on a given day. I forget what date. Oh, it's January 6, 2012. Okay, those were the option prices. So What we want to do is untangle what the market's thinking about the future from those prices. So we need a theory about how the market takes its expectations for the future and converts them into option prices. Let's take a look at that. We'll start with the binomial model, because it's the one I understand the best, so we'll do with the binomial model. So I like it the best too, actually. So here's the simplest model you could ever imagine for how a stock price changes over time. The stock price is S today, and let's say it's 1 day later, it's going to go up to AS or down to BS. A could be 1.1, B could be 0.9. It's going up, down, and it does it with a probability of F. So F is the chance that it goes up, and 1 minus F is the chance that it goes down. There's an interest rate of R in this world. You better have A be bigger than 1 plus R and B be less than 1 plus R. Because if A and B were both bigger than 1 plus R, no one would hold, it'd be a great equity premium because there'd be no risk. Everyone would just borrow and buy the stock. It would always beat, no matter if it went up or down, it'd be better. So to prevent arbitrage, prevent a free lunch, 1 plus the interest rate sandwich between, which says that if the stock goes up, it does better than the bond. If the stock goes down, it does worse than the bond. And a little bit of algebra gets you what Phil was talking about, those pure state prices. And we don't care so much about the algebra, but what's interesting is that P of A is the price of a security that's a derivative security on this stock. It's what's called a digital option. So P of A is a security, is the price of a security that pays $1 if that stock goes up and pays you nothing if it goes down. Let's call it, I'm here, I think I changed this euros. So this is €1 if it goes up and nothing if it goes down. And P of B is the opposite. It pays €1 off if the stock goes down and nothing otherwise. And this is just a derivative. Its value depends upon what happens to the stock, and it's traded in the marketplace. And you get the price for P of A and P of B, and then we can do some more stuff with this. We can use those derivatives, those digitals, to price any security at all. Because if a security, if it pays off a certain amount if the stock goes up and a certain amount if the stock goes down, then P of A times what it pays if it goes up, plus P of B times what it pays if it goes down will be the value of that derivative. But there's something very mysterious about this, as those of you who know this theory know something about. The mysterious thing is that if I go back to the original picture, remember, F is the probability the stock goes up. But F doesn't show up. So the value of a security, the price in the market of a security that pays off $1 if the stock goes up, doesn't depend upon the probability that the stock will go up. If you understand that, that's the first step to understanding modern finance 50 years ago. And I'm not going to explain it to you. But it's just a formula that comes out of just thinking about, is there a way to manipulate a bond and a stock, to form a portfolio of the bond and the stock, so that I can replicate that security that's going to pay $1 if the thing goes up? And there is, and you won't have to know the probability to be able to do it. So I can actually figure out that. Or another way to think about it is those securities that are derivative to the stock inherit the effect of the probability on the stock, so I don't need it. I'm pricing those securities as a function of what the stock price is. So that's wonderful, because it's very hard to measure the probability that the stock is going to go up or down, but it doesn't matter. I can price an option even if I don't know the probability. But the wonderfulness is lost as you try and do something with it, because however wonderful it is to not know the probability, it means the reverse is true. If I know the option price, the formula doesn't have the probability in it. So I can't figure out the probability from the option price. So the central thing I want to know about the stock, what's the probability it'll go up or down? I can't figure that out from the option price. So that carries through to all the more complicated models. So this next page is there to prove that I teach at MIT. You can see. So you either know this stuff or you don't. I'm not going to go through it all. But I'm going to call your attention to two equations on this page. The first equation is this there's a laser here. I don't mean to blind anyone, but yeah, there we go. Look at the first equation. That says the percentage change in the stock is the expected return in the next instant of time plus some random stuff. And so what we'd like to know is that expected return. We'd like to know what's the expected return on the stock. And then we go down to the price of the option, and I'm sort of blocked off here. Let's see. So I go down to the price of the option, that's the formula, and I don't see mu anywhere. It's the same thing. I can't get the expected return mu when I look at the option price. So I can't go backwards. So Black, Merton, Scholes, and by the way, in the history of the subject, that was really important. It was very important not to try and extract what the probability was or what the movement of the stock was from option prices. It was a world in which there weren't a lot of markets for options, but there was a stock and a bond, and you wanted to try and figure out what an option itself was. I mean, new options came along, you wanted to figure out what it would be. So you could have this wonderful formula that didn't require you to do any statistical analysis and figure out the expected return on the stock. So you could figure out what an option price was. And now we pay the price for this formula because it's a blessing and a curse. I want a different formula. I don't like that formula. I want a formula that will say, all right, the price of the option depends upon the expected return on the stock. So when I see the option price, I can somehow or other reverse engineer it and get the expected return on the stock. That's what we're trying to do here, trying to go backwards. So the way to do it, or I think a way to do it, I'll go further, I think the way to do it, you're very arrogant about it, I think the way to do it, is to go back to a different kind of a formula and a different kind of an intuition. What is a put option? A put option is a contract that pays off if the stock market goes down. So it protects you against the stock market going down. It's a form of insurance. And since it's insurance, like any insurance product, its price is a function of three things. First, when will it pay you off? Well, let's say a year from now. So you've got to discount the payment a year from now. Second, it's a function of how averse people are to risk. It's insurance. How much insurance you buy depends upon how much you care about the loss, insuring against the loss. And third, it's the thing we want. It's a function of the probability that you're actually going to suffer a loss, that the market will go down. So the higher the probability that the market will go down, in this simple formula, the more a put option is worth. And the more averse you are to risk, the more a put option is worth. And it's very hard to separate the last two items out, to separate out the risk aversion from the probability. And we have historical experiments where you can think you could do that. So when hurricanes go through in the United States, insurance companies lose a lot of money. Hurricane Sandy, Hurricane Katrina, they lose a lot of money, but they're smiling for the next few years. Because after they've lost all this money in Louisiana, insurance premiums for hurricanes went up threefold. It's a threefold increase. But as meteorologists will tell you, the probability of a hurricane isn't any higher. So if the probability isn't higher, the only thing that could be going on is that people got really scared of hurricanes. And so risk aversion went up. But of course, I can't even be confident of that. When you actually polled people, when premiums went up, you polled people about what they thought. They said, well, we just had a hurricane, we're going to have another one soon. So if people are mixing up the probabilities and the risk aversion, I can't be sure that the high premiums are just risk aversion. So what I want to know, and I'll assume I know the discount rate, that's pretty easy, but which is it when I see high premiums or high put prices? So today, put option prices are much higher than they were in the past. Implied volatility is a lot higher. Because there's been a lot of volatility in the market, the option prices are higher, People pay more, they're willing to pay more for insurance against a loss, but is that because they think the probability of a loss is higher today? Or is it because they're just really scared of it, more scared than they were before? So let's try and separate those two. So I'll go through a little bit of mathematics, but I'm going to let you. I think this is a good way to do it. So all you got to know is a little high school algebra here. So we start with the notion of what a state is. And in my description of an economy, a state basically lists all the things you need to know to predict what will happen in the future. All the things you care about. That's what a state is. So we can list all those things. The current market level, last month's return, might depend on the path a little bit, current implied volatility, a whole bunch of things. That's a state. And the world moves from one state to another. I'm trying to figure out the probability of that. So if I'm in state I today, I want to figure out the probability of getting to state J tomorrow. So Fij is that unknown probability. If I can find that, I'll know the whole distribution of returns. So Pij is the contingent price. It's the price of a security that pays a pure contingent security. It's a security that'll pay you $1 tomorrow if the world goes to state J, like a security that pays $1 if the stock goes up or down. So it's a security that pays $1 if it goes to J, if it's currently in I. And I can figure out all those PIJs from looking at market prices, and in particular from looking at options. And that's a well-established technology. There's a little bit of a trick to it. But we can find all the P's from puts and calls. I want to figure out the F's, the probabilities. If I knew that, I'd know the probability distribution of future returns. So I'll go quickly how to do that. I'll go really quickly how to do that. There we go. We don't have to do the math here. Here's what it comes down to. It comes down to, I can show you that there's as many equations as unknowns. There's actually one more unknown, but that's a little trick. And essentially, there's as many equations as unknowns, and you can solve them. If you remember from high school algebra, probably in Germany you did it in 4th grade. You're faster at math than we are, but in high school we learned in America that if the number of equations is equal to the number of unknowns, you can solve it, pretty much. So that's called the recovery theorem, and I've got a 3-step procedure for doing it. So first I pick a date, and I proceed as follows. I use the option prices to get those securities prices that I want, the Pij, the price of a contract that will pay me $1 if in the next hour I go from today's state I to state J, or if tomorrow. I use quarters often. If I go this quarter from I to J next quarter. And then the second step is I use those prices to I use the pure prices that I get from the first step to get those contingent prices. And then the third step is I apply this recovery theorem to do it. So it's a very different theory. It's a theory that goes back to the origins of insurance. But it's got to be consistent with modern option price. It can't be, not getting a whole bunch of new results, because that theory works pretty well. In fact, I use that theory, as you can see, to get the prices that I need. There's one trick to it. I'm going to talk it through, but I'm not going to go through the slides. I sit here today in a certain state, like the market's at 2,000 today. So the S&P's at 2,000. So I can figure out the price of $1 next quarter if the market's at 2010 or 2020 or 2003. That's what's traded on the market today. But what I need to know is, if the market, instead of being at 2,000 today, if it was at 2,100 today, what would be the price today of going to 1,900 next quarter? And it turns out there's a trick way to do that. You can actually figure that out too. So, more interesting than any of this, let's actually apply it. So that's the pure security price surface. So that tells you, and coming towards you is the maturity. So 0.75, 3/4 from now, 125, 5 quarters from now, 1750, so on. That's the number of quarters from now as the axis comes towards you. And then the market scenarios on the other axis, the market's up 9%, down 8%, up 19%, down 18%. I arrange those numbers. They're sort of funny numbers, but they're arranged so that if it goes up and then down, it gets to the same place. Okay? So as you see, it does what you sort of think. So up close to today, you've got that peak at the back. And that just says that in the next quarter, it's not going to go very far away. And as you come towards it, as you go out 2, 3, 4, 5 years, the distribution spreads, so the likelihood of going down or up is higher. This is the risk-neutral probability. Now we start to, I actually picked a day. So I picked May 1st, 2009. I picked that for a reason. As people said, Bob, I think you said, we don't have closed form solutions for any of this. And so it's really a lot of work to do it for even one day. So this is for one day. So I'm going to show you what this predicted on May of 2009, if you recall, was after the crisis. So after the crisis, what did this theory predict about what the market was going to do? Those are the risk-neutral probabilities that people in the market use to price securities. That's the risk aversion. So that's just a utility function, if you know about utility theory. And that's the recovered probability distribution. When I took out the risk premium, that's what I got. And it looked similar. It's not the same. I'll show you the differences. But up close to 1 quarter from now, the chances are it's not going to move very far away. And as you get closer today, it starts to move pretty far away. Here's the recovered probability versus the historical one on that date. So the theory predicted the red distribution. History had the green distribution. And the difference is interesting. So you see the red is a little fatter at the very far bottom. Right? So the probability of a drop, this is May 2009, the probability embedded in option prices of a crash was higher. But of course, the probability of a big gain was also higher. So it paid for it in the middle. Probability of staying where you were is pretty small, so almost a barbell. Here's the difference between the historical mean. Let's go to the recovered one. So a market scenario of 50% down, 40% down, 30%. The historical probability of a 50% or more drop in the next, I'm trying to remember what this was. I don't know. Can you read? Is there anything at the bottom there? So I don't know if it's 6 months from now or it might be, oh, on May 1st to May 1st, for a year from now. So the probability that you have a 50% drop in the next year was 0.005. The probability of a 40% drop, if you looked at history, had been 0.017. So sort of like a 1.7% chance, a 4.5% chance of a 30% drop. What did we get from this recovered theory? The chance of a 30% drop was twice as high, 8.5%, 8.3%. So the chance of a drop was higher, and then that's just reflected what we saw before. And this might be interesting. So this is what the expected return was. So the expected return from this recovery argument was 9.8%, which actually turned out to be a pretty good predictor. That's why I picked May 1st, because I knew it worked well for you. So it turned out to be a pretty good predictor of what happened in the next year. That was a really good return. So after the crash, people were quite optimistic, or at least the market seemed optimistic about what the stock market would do. Compared to history, it was much optimistic. And all the other numbers, the excess return was fully 7%. Remember, interest rates were so low. So even more striking than just the prediction for the market was the prediction for how much better the market would do than bonds would do. 7 versus the historical excess return of 3%. Sharpe ratio was 44. That's a great Sharpe ratio. So at the time, if you were in the business of investing, you should say, I think I'm really going to invest heavy in the stock market. That's what the recovered distribution said. So what are we going to do now? Well, I'm going to test this theory. I've been trying to for several years now. It just takes forever. I'm going to compare the recovered predictions with what actually happened afterwards. I'm going to extend it to fixed income. That's well underway. A lot of people have done that. So, and then I'm going to have to fight with a lot of other faculty who disagree with us. So there's a lot of factors. So why do they disagree? Well, they don't agree with certain assumptions that went into the mathematics of the model. And so we have a big debate going on. But it's okay. They've disagreed before, and they'll disagree again. So. But in the end, the proof is in the empirical work. Does it empirically predict? By the way, no one disagrees that it works in the fixed income market. So the disagreement is whether it works in the equity market. All right, that's it. Thank you very much.
Questions? Yeah.
One question that I would have is, you skipped over this relatively fast. What assumptions or what do you need? Because in essence, there's got to be some structure that allows you to pull apart the risk aversion and the probability. So what assumptions do you need to make on the risk aversion part in order to kind of pull those two apart?
It's a very good question. It's no magic to do this if you have a parametric model. There's no parametric model here. So the only assumptions that made is one that looks a lot like the assumptions we always make in all our models. It says that risk aversion, so the aversion of going from, let's say, a market of 2,000 to a market of 1,800 is just some function of 1,800 divided by a function of 2,000. So without saying what the function is or anything, it's really kind of remarkable how much you can get with so little assumptions, which gives me some confidence that this is getting at something that's really kind of primal or primitive in the market. So we can talk about the details, but almost no assumptions like that are made. No hard assumptions are made. So we can't really even argue about them because they're pretty unexceptional. Okay.
Steve, the interesting thing in your paper is that you need a random risk-free rate, otherwise the market turns out to be risk neutral. Now we have the European Central Bank, which fixes now the risk-free rate basically at 0 for the last 3 years and probably for the next 5 years. So we basically have 8 years with a fixed 0 risk-free rate. Now, is that something which bothers you very much, or would you say, even though my risk-free rate is in a sense endogenous in the model, I don't care whether the European Central Bank fixes the risk-free rate at 0?
That's an excellent question. There's sort of two directions to go in to answer it. One is they fix the nominal rate, but they don't necessarily fix the real rate. The second question, the second point, which I think is more significant, is that they're sitting here today, we're in our current state, and they're announcing that they're going to fix it because we're in this state. But they're not announcing that no matter what happens and what state we go to, that they'll continue to fix it at that rate. So clearly, when I look at these interest rates across the states, and I can derive them by looking at interest rate derivatives, when I look at those, embedded in that is the presumption that they're going to change it in the future when the world changes. So I don't have something that's absolutely fixed. The fixing of the interest rate across all the states of nature is really kind of a big assumption. And that's the only way it would ever break down. And if that happened, if the interest rate never changed, and that's actually part of the original models, you know. So if you look at Black-Scholes-Merton, you look at the binomial model, we don't spend a lot of time with a changing interest rate. We have the interest rate stay the same all the time. Right? That's why you can't recover.